James had $180,000 saved in his 401k. Then one morning, the stock market crashed. Everything changed overnight. The Dow dropped 1,500 points in a single day. James watched his retirement account lose thousands in just hours. This is not just a story. It happened in 2008. Millions of Americans lost up to 50% of their 401k overnight. But here's the truth nobody tells you. A market crash does not mean your money is gone, not permanently. Your 401k loses value on paper, but you only truly lose money if you panic and sell immediately. In 2008, the market dropped 57%. By 2013, it had fully recovered. Investors who stayed in won. James called his financial advisor in a panic. He wanted to pull everything out immediately. Big mistake. Pulling out during a crash locks in your losses forever. You miss the entire recovery. That is truly devastating. James stayed in. His advisor convinced him to wait. That one decision saved his entire retirement future. But not everyone was so lucky. Millions sold in panic during 2008. They never fully recovered their savings. So what actually happens inside your 401k during a crash? Let us break it down simply, right now. Your 401k holds mutual funds and index funds. When markets drop, these fund values fall temporarily, not permanently. Think of it like a house. Market crashes lower its price temporarily, but the house still exists, fully intact. The biggest danger during a crash is not the market itself, it's your own emotional reaction, every single time. Studies show investors who did nothing during crashes outperformed those who actively managed their portfolios significantly. James kept contributing every month even during the crash. He was buying funds at massive discounts. Smart move. This strategy is called dollar cost averaging. You buy more shares when prices are low, automatically over time. By 2012, James's 401k had not just recovered, it had grown beyond his original balance, completely past it. The market has recovered from every single crash in history, every recession, every panic, without one single exception. So, if a crash hits tomorrow, do not panic. Stay invested. Keep contributing. Your future self will thank you. Now let us talk about something even more important. What should you actually do the moment a crash begins? Step by step. Step 1. Do not check your 401k balance every single day. Constant checking leads to panic. Panic leads to bad decisions. Step 2. Keep your automatic contributions running. Do not pause them. A crash is actually the best time to buy more. Step 3. Review your asset allocation. If you are close to retirement, your mix of stocks and bonds truly matters now. If you are 30 years old, a crash is honestly a gift. You have decades to recover and grow even bigger than before. But if you are 60 years old and retiring in 2 years, a crash hits very differently. Your strategy must change immediately. This is why financial experts always say the closer you are to retirement, the more bonds you should hold, always. James was 38 during the 2008 crash. He had 27 full years left to recover. Time was completely on his side. But his coworker Mike was 61. He panicked and sold everything. He had to delay retirement by 4 painful years. 2 people, same crash, completely opposite outcomes. The only difference was their age and their emotional response to fear. Now here is something most people completely overlook. A 401k crash also brings a hidden opportunity most investors never use. It is called a Roth conversion. During a crash, your traditional 401k balance is lower. Converting to Roth costs significantly less in taxes. Most people never think about taxes during a crash, but smart investors use this exact moment to save thousands of dollars. Another hidden opportunity is rebalancing your portfolio.
A crash shifts your allocation automatically. Rebalancing brings it back on track. Rebalancing means selling what held its value and buying what dropped hard. You are essentially buying low automatically every time. Warren Buffett once said, "Be greedy when others are fearful." A market crash is exactly the moment he was talking about. The investors who built generational wealth did not run from crashes. They ran toward them with confidence and extra cash ready. James increased his 401k contribution by 2% during the crash. That single move added over $60,000 long term. Small decisions during a crash create massive differences over decades. This is exactly why financial literacy changes everything for everyone. Coming up next, we will show you exactly what happens to Social Security during a market crash. You need to know this.
Social Security is completely separate from your 401k. A stock market crash does not directly reduce your Social Security benefits at all. However, if the crash causes a deep recession, the government may struggle to fully fund Social Security for future retirees long term. This is exactly why relying only on Social Security for retirement is genuinely one of the biggest financial mistakes Americans make today. The average Social Security payment in 2024 was only around $1,907 per month. That barely covers basic rent in most American cities. James knew this early, so he treated his 401k as his primary retirement plan and Social Security as just a small bonus income. That mindset shift alone puts you miles ahead of the average American who is counting on government checks to survive retirement completely. Now, let us talk about the worst-case scenario. What if the market crashes and takes 10 full years to fully recover completely? Even in that extreme scenario, investors who kept contributing throughout every single month came out significantly ahead of those who stopped entirely. The market has never permanently gone to zero in all of American history, not once, not even during the Great Depression, ever. That long-term chart is the single most powerful argument for staying invested no matter what happens in the short term today. But here's the emotional reality. Watching your 401k drop by $40,000 in 1 week feels absolutely terrifying every time. Your brain is literally wired to treat financial loss as physical danger. That is why panic selling feels like the right move. Behavioral economists call this loss aversion. Losing $100 feels twice as painful as gaining $100 ever feels good. Knowing this about your own brain gives you a massive advantage over investors who act purely on raw emotion and fear alone. The investors who truly understand market psychology consistently outperform those who simply chase returns and panic every single time markets drop. James wrote himself a simple rule. If the market drops more than 20%, I will increase my contribution automatically, not decrease it. That one personal rule removed all emotion from his investing decisions completely. He never had to think twice during any future crash again. Mike had worked for 35 straight years building his retirement savings carefully. That one panicked decision in 2008 erased decades of disciplined hard work. Mike went back to work at 63 years old, greeting customers at a retail store, all because of one emotional decision during one bad week. James almost sold everything twice during that crash. Both times he closed the app and called his advisor instead. That saved him completely. His advisor gave him one simple trick. Before making any crash decision, wait exactly 48 hours. That cooling period changes everything for every investor.
Hey guys, welcome to another video. This is James. Remember the name James. My name is James. My outro is my intro. If you like this video, if you love these visuals, then don't forget to subscribe this channel. And I have a new task for you. Try to hit like and subscribe button with your nose. Thank you for watching. Love you all.